Hey everyone, this is Mike DeBliss. In this podcast, I'm going to talk about what legal entity you should choose for your small business. I'm going to talk about the sole proprietorship, the limited partnership. We'll discuss corporations, limited liability companies, and then we'll move on to talking about the costs of formation and maintenance, tax consequences, and end with state of formation. So this is basically meant to give you a breakdown of the various legal entities that exist and to give you an idea or plant a seed in your head for which ones might be most suitable for your new business. So the way to back into this is to recognize that one of the key decisions you have to make at the early stages of starting your new company is whether to operate the business as a sole proprietor or structure it as a limited partnership, limited liability company, or corporation. We often throw these terms around, but it's important to know the details of each one because they're creatures in and of themselves, and in some cases, it might be black and white as to what legal entity is best for your small business. In other cases, it may be a gray area where you need to consult with a business attorney or tax professional to determine at the end of the day which one is going to serve your needs and fulfill your purpose. Let's begin with the sole proprietorship. A sole proprietor is someone who owns an unincorporated business by himself. Sole proprietors do not enjoy the benefit of the legal distinction between the individual and the business like the corporation does. And so the sole proprietor is personally liable for all of the debts and other obligations of the business. Now, a limited partnership is an association of two or more people who carry on as co-owners of a business for profit. A limited partnership must have at least one limited partner and one general partner. So that's the bare minimum requirement. There must be at least one limited partner and one general partner. So let's begin with the general partners. They're personally liable for all of the debts and obligations of the business. But the limited partners typically are not. So that's one distinction right there. Again, the general partners are personally liable for the debts and obligations of the business. Limited partners typically aren't. Limited partners, however, may not participate in the management of the business or they'll lose their limited liability status. So while it is good that the limited partners may not be personally liable for the debts and obligations of the business, it's important to recognize that they may not participate in the management of the business or they'll lose their limited liability status. How is a limited partnership formed? Well, it's formed by executing a partnership agreement and filing a certificate of limited partnership with the Department of State. Corporations. So what is a corporation? A corporation is a legal entity. It is, for all intents and purposes, a creature unto itself. It's a separate being. When you think about that, you almost think about like a second head sticking out of the shoulder of an alien or something. But it is a legal entity which is separate and distinct from the individual shareholders. And so, as a legal entity, it grants limited liability to its owners, or what we would call shareholders. Therefore, the shareholders of a corporation generally are not personally liable for the debts and obligations of the business. Now, there is a theory under the law called piercing of the corporate veil. And I'm going to talk about that in another podcast because that legal theory could actually cause the shareholders to be personally liable for the debts and obligations of the business if they are not adhering with the requirements of being a corporation. And again, that's a topic for a future podcast. But generally speaking, the shareholders of a corporation aren't personally liable for the debts and obligations of the corporation. In a corporation, shareholders basically have voting power. They can vote on certain significant matters, and they directly or indirectly elect management. When I talk of management, I'm referring to directors and officers. The management is then responsible for operating the business. Now, you've probably heard that there are two different types of corporations. There's what's called a C Corp, and then there's what's called an S Corporation. An S Corporation isn't necessarily a type of corporation as much as it is a tax, as much as it refers to special tax, as much as it refers to a special tax tax element of formation. And I've talked about that in other podcasts, but essentially an S corporation's a corporation is designated as an S corporation because of a particular tax incentive that distinguishes it from a C corporation. So let's talk about how a corporation is formed. It's formed by filing a certificate of incorporation with the Department of State and by preparing bylaws. Now, S corporations can issue only one class of company stock and are limited to a maximum of 100 individual shareholders, all of whom must be U.S. residents. Very important to note that. So any non-U.S. resident who, for example, is the 100th shareholder could very well rock the boat on the classification of the corporation as an S Corp, because again, the requirement is that all of the individual shareholders must be U.S. residents. And of course, there is a limit to the number of individual shareholders that an S Corp can have, and that is capped at 100. Limited liability companies. These are oftentimes considered the holy grail for small businesses because of the various incentives that it offers the owners, as well as the limited liability that it affords owners, as one can see in its name. So what is a limited liability? It's an unincorporated organization of one or more members, so there has to be at least one member, each having limited liability for the contractual and other liabilities of the company. The owners of an LLC are referred to as members. So unlike partnerships where you have two classifications of partners that we talked about earlier, where there's a general partner and a limited partner, in an LLC they're all referred to as members. LLCs can be managed by the members like a general partnership or by one or more managers like a limited partnership. The managers of an LLC may or may not be members. Members are required to adopt an operating agreement which sets forth the rights and obligations of the members and how the company will be operated. So it's kind of like it is an operating agreement, and it basically puts forth the rights and obligations of the members and how the company will be operated. It's like it's like the charter, so to speak, where it basically describes how this company is going to be operated. And it's good to draft that up front because that way you actually have to sit down with other members and flesh all of this out. And in some cases, where there are ideas that other people have, fleshing this out in the beginning stages is often good, because later on, if there's any misunderstanding, it could end in a dissolution of the LLC and in a very bitter dispute between members. So getting this out in the beginning is often very helpful, and what better way to do that than through the operating agreement. So how is the LLC formed? It's formed by filing articles of organization with the Department of State and preparing an operating agreement. Now, LLCs offer a number of advantages over S corporations. For starters, LLCs can offer several different classes of membership with different rights. There's also no restriction on the number of individuals, corporations, and partnerships who can participate in an LLC. It's unlimited, whereas if you remember with the S corporation, it's capped at 100. LLCs, and for that matter limited partnerships, generally operate with fewer formalities and enjoy greater flexibility in their business operations and management than corporations do. And here's a quick and dirty example to illustrate this. An LLC doesn't have to have a board of directors. So whereas with a corporation and the necessity of having a board of directors, again, an LLC is kind of like a loosely formed corporation. There's no requirement that there be a board of directors, nor is there any requirement that the LLC scrupulously adhere to certain reporting requirements, nor are they subject to the same arduous rules, disclosures, and expensive accounting as a corporation. Furthermore, unlike corporations, LLCs and partnerships have flexibility in allocating business profits. So these are some of the things that distinguish LLCs from corporations and make them an enticing business entity for those who are launching small businesses. Let's talk now about costs of formation and maintenance. LLCs and partnerships are much easier to operate and maintain than corporations. We already discussed one of the reasons. There's no requirement that for accounting, and accounting can get very expensive very quickly when you talk about having to delve into the weeds, so to speak, and hire a CPA to show gross income, expenses, net losses. As you can imagine, your head's already probably spinning around in circles thinking about all of those spreadsheets and all of the hieroglyphics that go along with an accounting. And at the same time, the LLCs and partnerships don't have to comply with these arduous rules, the same arduous rules as corporations do. So they're perceived as being easier to operate and maintain than corporations. However, forming LLCs and partnerships in New Jersey and New York, for that matter, involve greater upfront out-of-pocket costs than many other legal entities. Formation costs may also include attorney fees for an operating agreement for your LLC or a partnership agreement for your limited partnership. So sometimes that gets overlooked, the fact that there are attorney fees that go into drafting an operating agreement if you're going with an LLC, or attorney fees that go along with drafting a partnership agreement if you are forming a limited partnership. Other costs include IRS form fees, because there are IRS forms that accompany both of these creatures, as well as fees for obtaining licenses or permits to operate your business in the state that you're operating it in. Let's get into the tax consequences. I think that's like paramount when it comes to selecting an entity. It's not the be-all, end-all, but it's one of the driving things or impetuses behind which business entity small businesses select. Beginning with C corporations, they're subject to double taxation, and here's what I mean by that. If you recall earlier, I talked about how the corporation is a separate creature than the shareholders. It's basically considered an individual in the world of tax, and is even given that designation in the Internal Revenue Code. The corporation pays federal income tax on its profits. The shareholders pay income tax on any dividends they receive, and there is double taxation of capital gains upon dissolution or upon the ending of the corporation. So here's what I mean. If the corporation decides to issue dividends or make a distribution to the individual shareholders, the corporation first pays federal income tax on the profits before it makes the distribution or the dividends to the individual shareholders. So that's the first layer of taxation, the federal income tax on the profits of the corporation. When the shareholders receive the distribution or dividend, they in turn have to pay income tax on those dividends that they receive. So what's happening here is that if we start out with, say, $50,000 in profits that the corporation has, in which the corporation intends to delegate in the form of dividends to its shareholders, $50,000, let's say that there are 5 shareholders and that each shareholder is going to receive a distribution of $5,000. Well, here's how the pie is divvied up. That $50,000 is subject to federal income tax payable to the IRS. And let's say that after it's taxed, it's now $30,000. Well, now that $30,000 is distributed among the 5 shareholders at $6,000 each. So each individual shareholder would receive $6,000 because $30,000 is what's left after the $50,000 is taxed. The $6,000 dividend that each shareholder receives must in turn be reported by that shareholder and is subject to tax. So at the end of the day, depending on what the tax bracket of that shareholder is in, that $6,000 could very easily be reduced to $4,000 or less, depending again on the tax bracket that that individual shareholder is in. These days it's looking to be around 31-32% as a result of tax reform, because that's what our individual income tax rate has gone down to. It used to be around 35%. So and then the other issue I was talking about before is that there is double taxation of capital gains upon dissolution of the corporation. On the other hand, S corporations and LLCs combine many of the advantages of a C corporation, such as limited liability, with the flexibility of a partnership, such as pass-through taxation. So what does pass-through taxation mean? It means that the partnership is not subject to income tax like the corporation is. So if we're using that example of $50,000, it doesn't get taxed at the entity level because a partnership is not considered a separate creature in the same way that a corporation is from its individual shareholders. The partners, however, have to pay income tax on whatever share they're getting because it's a pass-through. However, the partners, and it's important to note this, are individually liable for their shares of the business income, and that means that the partners in a partnership do not escape taxation at all. It just means that at the partnership level, there is no taxation of the profits. They simply pass through or flow to the individual partners, who in turn are individually liable for their shares of the business's income, meaning that they must report those profits to the IRS and pay taxes on the profits that they receive. S corporations, for federal income tax purposes, are treated as a corporation for New York tax purposes. And this is basically dealing with New York. Suffice to say, in other states follow the New York model as well. So what that means is that S corporations formed in New York are subject to a New York State corporation franchise tax. However, if it's anticipated that your startup will experience net operating losses initially, making an S election can be desirable. And that's actually how a corporation gets to be an S corporation, by making an election. Let's talk about buying and selling LLC and partnership interests. The first thing to recognize here is that buying and selling LLC and partnership interest is not child's play. It raises complicated tax issues. In contrast, buying and selling corporate stock is pretty much straightforward. We do this all the time. It happens on the New York Stock Exchange. Stock is exchanged and sold freely, and again, it happens. It's a lot less complicated than the tax issues that arise when it comes to buying and selling LLC and partnership interests. One reason why the sale of LLC interest is so complicated is that a member's basis in an LLC interest changes frequently. And an example of that is that the allocations of LLC profits and losses to the members, distribution of LLC cash and other assets to members, and admission of new members all cause for a litany of complicated and overlapping issues that are enough to cause even a CPA a migraine. And so this is one of the reasons why the sale of LLC interest is so complicated. And whenever you hear the word members basis or simply basis, you know that you're getting into an accounting issue, and that is going to necessitate an accountant getting involved. So all this to say, before you start your new company, you should get some legal advice in advance. At least speak to an attorney to help you with some tax planning and restructuring, so that you can see what alternatives might work better for you, and which vehicle or business entity is going to help you best advance your interests. And it's important to note that there isn't one size that fits all here. Everybody comes to the table with different goals and different end games. There are some people that are starting small businesses because they want to be able to sell them in the near future. Other people are, starting business with other family members and would like to see it go be passed down from generation to generation. And so those are two separate goals, and that can drive the type of business entity that is selected and that's best suited for the business owners. State of formation. Once you decide what entity you plan to form, you should give some thought to which state the proposed entity will be formed. If your business is going to be conducted primarily within, say, New Jersey, there probably isn't a reason to incorporate it in another state. And the reason why that has significance is because a foreign company usually has to qualify to do business in New Jersey. And in order to qualify, part of that means paying fees in addition to a litany of paperwork. So if you know that your business is going to be conducted primarily within one state, and in this example I gave New Jersey, then it probably isn't necessary to incorporate in another state. Now, you will have companies that are incorporated in other states primarily because of strategic advantages that can be gained by incorporating in other states. For example, Delaware is considered to be a very friendly haven for business, and many of the judges that oversee these cases that go to litigation are very versatile in business organizations and have a firmer grasp on business organization issues than judges in other states. So Delaware tends to be a very favorable venue or jurisdiction for incorporating a business. And that's why you will see companies that are in the Midwest or even as far west as California that primarily do business in California but are incorporated in Delaware. Since the most frequent reason for choosing one entity type over another and the ultimate decision as to its state of formation is usually based on the perceived tax benefits, you should consult an accountant for advice prior to forming the entity. And we covered this earlier. Again, I can't state this enough. Because tax benefits are one of the driving forces in what type of entity you form, in addition to, of course, the state of formation. You always want to include an accountant in the decision about what type of entity is best suited for you. So while these types of business entities are similar in some respects, as you can see, there are significant differences regarding formation requirements, startup costs, operational formalities, and tax consequences. You cannot go wrong by seeking professional advice in advance before beginning your maiden voyage on your startup. Again, it's far better to know in advance what the ground rules are and and how these different business organizations operate, because later on down the line it may be too late, especially if there is litigation on the horizon, or especially if there are issues that arise between the individual members or partners that might otherwise have been dealt with if in the beginning the members or partners had sat down and done some more research into which business formation or which business entity was best suited for them. If you have any questions, feel free to give me a shout. You can always email me at mjdebliss@deblisslaw.com. My